This week had a lot of news. The biggest story was from inflation and the changes in oil prices. We got PCE, that's the Fed's favorite measure of inflation, at least for now, and that came in hot on Thursday. Headline inflation was up and kind of looked bad, but oil is under $70 a barrel as of now, and the market kind of ignored the PCE number because it knows a lot of that inflation's coming from higher energy prices, and that energy is heading in the right direction now. Plus, a third of the core PCE jump came from portfolio management fees, which we've talked about isn't really inflation. It's the same percentage. It's being multiplied by a bigger investment account because the markets are up and so are people's investments. If you strip that out, you would see core inflation was actually pretty tame. Shelter is still being overstated compared to real-time rental figures, which just means that number is going to look better in future reports too. I know it seems like I've probably been saying that forever, but it's bound to happen. And the Dallas Fed trim mean, this is what the new Fed chair wants to look at, removes the most extreme price swings on both ends, and that came in at 2.4% for May. So again, this is the measure Kevin Warsh is leaning toward using as the new benchmark for the Fed's inflation targets. It's going to show a cleaner picture of what's actually happening in the economy, and that's going to be in more real time. And Warsh is already getting early support. The New York Fed president said he expects inflation to come down as tariffs effects kind of fade, and shelter continues to cool. He's not looking to hike. And the Chicago Fed president also praised Warsh's no forward guidance approach. The Fed's still kind of in wait and see mode, but Warsh's 5 research task forces don't report till the end of the year, so that could give them room to hold rates steady in the meantime, at least till for the rest of 2026. And then GDP final Q1 reading came in stronger than expected, but really not as encouraging as it sounds. Consumer spending was weaker than previously thought, and most of the growth came from AI data center investment. So the underlying economy is still showing signs of slowing. As far as the Strait of Hormuz goes, oil prices have kept falling despite an incident where a ship was attacked for taking the wrong route yesterday, but other ships have passed through since, so it looks like more of a one-off, and the ceasefire doesn't look like it's going to be threatened. The Strait is closer to normal, but it's not fully there yet, and oil and rates are going to stay connected until that situation is fully resolved. Separately, we saw the median monthly mortgage payment hit a one-year high in May, and that was almost $2,200 a month. Third straight monthly increase, just showing, the affordability decline is happening. It was seen in 33 states, and the trend has been moving in the wrong direction. Buyers are obviously feeling that, but there's a lot we can do to help buyers with affordability concerns, so just reach out to discuss that. Sadly, Alan Greenspan did pass away this week. He led the Fed through some of the most complex economic cycles in modern history, and Warsh, the new Fed chair, has credited him as a major influence, specifically in how he thought about productivity as an inflation offset, and worth knowing that context for how he will, as the new Fed chair, think. But next week's a big one. We're going to get, it's jobs week. JOLTS, ADP, jobless claims, and the BLS jobs report will all come in. So eyes are on the labor market. But I'll see you next Friday to let you know how things look.